Hey, everybody. Welcome. Thank you very much for tuning in. My name is Matthew. Just when you thought we were finished with our money supply series, I have a little bonus episode for you here today. I'm going to answer the question, where do credit cards fit in to the money supply? All right. So here we go. Credit cards. I think I might have mentioned them once in an early video, maybe not even a video about the money supply in passing, but I purposely have not addressed them at all yet because I wanted to save that for this video. And I didn't want to confuse the picture of drawing all of our public-facing money supplies when we had this sort of interesting market that was there in the ether, which probably most all of you, if you're over 18 watching this video, have a credit card and certainly probably use it daily, if not weekly for sure. So credit cards are certainly popular instruments. They have some privacy issues, to be sure, but they are instruments that allow payments to occur throughout the economy and throughout the world. Visa, Amex, MasterCard, most kiosks, vendors worldwide will accept some form of at least one of those companies as cards, and there are others. Could be more, but there are others. So where do they all fit in to the money supply? That's what we're going to address right now. So now I'm going to draw again the public-facing money supply for the entire United States, going all the way up to M3, which you won't find this anywhere else. So reconstructed in this manner, we have M0. That is all physical cash and coin that exists in the economy outside of bank vaults in the United States. And as cash can't be controlled really across borders, there's no doubt, and many people know, the American $100 bill, Benjamins, they circulate quite popularly, even outside the shores of the United States. Nonetheless, this is the entire physical cash that is outside of bank vaults, as reported by the Federal Reserve, M0. Now, we're going to move into bank money again, and this bank money is going to be green. Why green? Because it's not state money. M0 is part of the M public-facing money supplies, but it's state money. Now we're moving into bank money. M0 is in the blue. Now we have M1, non-M0, because this chart, again, it's stacked. So what is the M1 portion that is not M0? Because remember, this is cumulative. M0 is a part of M1. That is the demand deposit, or the checking account. And you see the massive COVID stimulus here, stimulus checks coming into the economy, and why everybody is worried about inflation more than ever, even more than the global financial crisis money printing that the Federal Reserve did on the bank side, because now we have public-facing money. That is huge. That is huge since COVID kicked off. And then we have the M2 money supply. I'm going to stack it on top. Remember, it's cumulative. Here's the non-M1 portion of M2. The biggest portion of this is savings deposits, retail type, less regulated, sometimes less liquid money. Then M3. This is reconstructed. You won't find this anywhere, but the data definitely exists. And there is a little bit more here. This is M3. There is a little bit more, no doubt, in the form of the Eurodollar, but I do have some Eurodollars that are captured here. I have stable coins as well. Anything that's basically a more institutional type, less regulated dollar account, large time deposits, institutional money market funds, also Eurodollars, repurchase agreements, they're all in M3. So this is the United States public-facing money supply. Most of it. You stack all three of these money supplies together, you add them up, you will get about $31.5 trillion is the total public-facing money supply in the United States. We have covered this. Definitely, if you have any questions, check out prior videos where we cover this in depth. Now, where do credit cards fit in? As I mentioned, probably everyone has a credit card. Probably everyone has used a credit card if you're an adult. If you're not, you're either super concerned about your privacy or you don't go out much, most everyone has a credit card. It is a very ubiquitous type of monetary media that does facilitate transactions. So, where are credit card transactions in this public-facing money supply stack? The answer is nowhere. Nowhere. Credit cards are not included in the public-facing United States money supply. How can that be? Well, for that, very, very quick lesson here. Again, it always comes back to assets and liabilities. Assets and liabilities. Banks have assets. Banks have liabilities. The central bank has assets. The central bank has liabilities. You, on your own personal balance sheet, you have assets and you have liabilities. Remember what I said about all of these public-facing money supplies. They are a liability, mostly for banks, but also in the case of the Federal Reserve, the blue shaded portion there, M0, it's a liability for the central bank. Public-facing money supplies, you always count up. Anytime you're just going to count up money, talk about money, it's a liability for the fiduciary. It's a liability for the bank or the central bank. That's just how it works. So this is fiduciary media issued by banks in green or the central bank in blue. And that fiduciary media is a liability for them. So credit cards, let's think about what happens during a credit card transaction for you individually. You go to a department store, you go to a restaurant, a bar, whatever. You swipe your credit card, you use it, enjoy your meal, your beer, your clothes, whatever you purchase. You leave the store, you leave the bar. What just happened? What happened to the money supply when you swiped your credit card and you physically took goods out of the store, or you ate or drank some food in this service establishment, wherever, whatever you were doing? You certainly used and partook in one side of the transaction. So what happened to the money supply? The answer is nothing at all. Nothing happened to the money supply at all at that point. This is how credit cards work. The only thing that happened was there is a little tick now next to your personal balance sheet that is a liability, and there is a little tick that is next to the merchant's balance sheet that is an asset. And who managed those little ticks, who managed those little items on the spreadsheet that matched, $100 worth of value? Who did that? The credit card company. Literally a company that manages magnetic strips on cards via a spreadsheet that both their clients and customers on the purchase side, i.e. you, and on the merchant side, i.e. the restaurant, bar, shop, whatever, agrees on and agrees to use. So that's literally all that happened in a credit card transaction. You have agreed that you will pay back within a predefined period, usually within 30 days. Could be even a little bit more than 30 days, depending on the credit card cycle, where in the cycle you made the purchase. And the credit card company agrees, usually even within a sooner time frame, to deposit some cash into the merchant's bank account. Could be within a month, could be within a week. That's how credit cards work. So notice the act of depositing into an account, right? That takes time. There's a float there. There's, T plus 10, T plus 30, could be even more than 30. And if you don't pay off the balance, it's definitely more than 30, but you also got to pay interest on top of that. Nothing hit the money supply at the precise moment of the transaction. At the precise moment of the transaction, you simply walked away with your goods or enjoyed your beer. The merchant didn't receive anything. All that has been done on both sides is that a promise was made by you to the credit card company to pay them back for this transaction, for facilitating this transaction. And the merchant has been promised by the credit card company to be paid by them within the month or maybe within the week. So credit cards are a different beast entirely than bank money, than a checking account, a savings account, a time deposit account. And again, there are asset and liability features to all of this media, all of this fiduciary media that it is called. And indeed, we do call it money, right? We say, I paid for my hotel already. I paid you my money. You know, if you go to a hotel and you put the credit card down, has your card been charged? Has it not? You leave the restaurant. I paid you. It's over. We're done, right? But with credit cards, it's actually not done at that point. The credit card company still needs to clear both from your side, the customer side, to the merchant side. They need to clear. They need to receive money from you, so you have a liability to the credit card company, and the credit card company has a liability to the merchant. Notice, literally dissect the words of when I say you need to pay the credit card company and the credit card company needs to pay the merchant. That is, at that point, when that payment hits, i.e. when you wire or ACH some money from your checking account to the credit card company, and when the credit card company ACHs or wires money from their bank account to the merchant's account, that is when the transaction is finally settled. And of course, it's never settled in one individual transaction, right? It's not even settled in one night's worth of transaction at a bar or one day's worth of transactions at a department store or any other store. What happens with credit cards, the beauty of credit cards in the financial system, is that you can batch transactions. You can simply add them all up. The days, weeks, sometimes even months worth of transactions from the merchant side, the credit card company just pays the merchant in cash once for all of those transactions. And on the other side, on the individual customer client side, it's batched at least by customer. So they don't have to pay, one ACH or wire transaction to the credit card company for every and each single transaction they make. Of course, no. They batch up all of the purchases that they made over the month, and then they make a payment. And of course, there are more fees and credits and reward points and all of that, which is also fiduciary media, by the way, balancing this stuff out. And if you, as a customer of the credit card company, choose not to pay your balance within that month, you will have a further liability known as an interest payment line item on your credit card statement. So credit cards are completely different, in fact, than the money supply that you see on this screen. A completely different beast, completely different animal. Yet, they actually allow payments to scale in a huge way compared to what you see here. So I'll throw out just two numbers right now. I looked before recording here. If you looked at total U.S. purchase volume of credit cards in 2022, it was $9.5 trillion. Purchases made in the United States with credit cards in 2022. And of that, Visa is $5.83 trillion, or about 60%. And so if you look at this chart, let's just break them all down here. Let's just round it. All right, $10 trillion in credit card transactions in 2022. That's 5 times more than M0. That's 30% more than non-M0 M1, i.e. demand deposits. 30% more. And it's a little bit less than M2, and it's about the same as M3. So it's a major part of the, quote, money supply without being a part of it at all. It's completely detached from the money supply. It's just a spreadsheet of assets and liabilities floating around. It's not actual bank money. It's not actual state money. $10 trillion in purchases. $10 trillion in purchases in the United States with credit cards in 2022. That is the gross purchase volume. And I don't have that data going back in time yet to show you, say, a comparison of how the other money supplies looked in comparison to credit card purchases. But what I can show you is the actual amount of credit card debt that has stacked up over the years and gone up and down over the years. And we can compare that to the money supplies. And that might surprise you. It's actually quite low compared to all of these money supplies. So I'm going to draw that in black, a black line right now. This is total revolving credit for the United States. At the moment, it's about half the size of M0. All the physical cash that's outside of banks in the United States, $2.2 trillion of that. Total revolving credit, $1.2 trillion. So remember, I told you total purchase volume in 2022 in the United States was $10 trillion, let's say. All right. Actual credit card balance, the liabilities that don't get paid off by Americans every month in the cycle, is about 10% of that. Now, I'm not saying that's a good thing. You should definitely always pay your credit card debt, even though they say, yeah, it can boost your rating if you have a small balance and pay that, so on and so forth. Not financial advice. Do what you want to do what you need to do. But credit card debt is actually a very small outstanding component of the money supply. So let's zoom in here, even from the financial crisis. Let's just show this again. So again, all of the green and the blue, these are liabilities from the banks and the central banks to you, to the public-facing side of the economy. They are your assets. These are all your monetary assets in green and blue. But the credit card stuff here, the credit card revolving credit, this line, that's a liability. That's what you have to pay back. So you can start to see we can build out balance sheets here for consumers, for individuals, for companies. Of course, mostly consumers use credit cards, although there are corporate cards as well. But this is total revolving credit in the United States. It's actually a very small portion of the money supply. Now, I'm not saying that it's all great, though. Let's compare now on the right axis here. You see the percentages. Let's look at the credit card debt versus the most important thing that we talk about when we're going to pay the credit card company. What is that? That's the checking account, the demand deposit account, the non-M0 portion of M1. The darkest green here on the chart. So let's take off M2, let's take off M3. Now we're just looking, actually let's take off M0 too. Now we're just looking at credit cards, credit card debt versus checking accounts. And you see it was pretty close here to being equal during the global financial crisis. Actually, I think December 2007, it was its highest. $1 trillion of credit card debt, $1.08 trillion of demand deposits. So very, very close to being equal. Let's look at this now as a percentage. This starts to show a more interesting picture. Here you can see just the accumulation of credit card spending and debt in the 80s and 90s, whereas basically nothing, non-existent. People wouldn't carry balances as a proportion of their checking accounts, as a proportion of the money that they had in the bank. To the eve of the financial crisis, right after Bear Stearns, end of 2007, start of 2008, you're at 93%. 93% of credit card debt to checking accounts. That means that if everyone in America paid off their credit card debt, there would basically be no money in checking accounts. And of course, that's not an even distribution. Many people have more credit card debt. Many people have none. Some people have more money in checking accounts than other people do, so on and so forth. But in a macro total level, credit card debt was huge here, pre-financial crisis. But now, ever since 2008, and certainly since COVID, but that's a slightly different story, but even ever since 2008 here, savings rates are growing. People are being more cautious. They're spending less. They're taking less credit card debt. So this actually is a good thing. It actually is a good thing. And it even went lower here after COVID, but why did that happen? Well, because of all the money printing, all of the government stimulus that happened during COVID. You just see it was about 32% credit card debt versus demand deposits. In February 2020, the ballooning of the non-M0 M1 portion of the money supply basically halved that. It halved the credit card debt as a proportion of bank accounts, of checking accounts, as of today. So there's a little bit of, a mixed bag there. You can say credit card debt is falling as a proportion of total demand deposits, but then you have to worry about the value of the dollar, of course, because we have massive amounts of money printing. And this is part of another story, which we will talk about in future videos. Massive amounts of money printing that has occurred with really no underlying savings in the economy justifying that, other than just stimulus and avoiding, people not being able to go to the factory or work because of government policies. You could say it's good that credit card debt is at 16%. Like, look, the last time it was there, you got to go back to 1981 levels. Yeah, mid-1981 levels. That's pretty good to say that. But the state of the dollar itself is obviously very, very different than the start of the 1980s. But if we take even that off, let's take M1 off too. Let's just look here. And again, I always look at just another side point, non-seasonally adjusted data. Always look at non-seasonally adjusted data. Never adjust the data because it's more interesting. You can actually see what happens. You can still cover year-on-year growth. You can do compound growth, all these things, and we can cover percentages of money supplies. But look how interesting it is that credit cards, they jump, just like physical cash. They jump every year at Christmas time, Black Friday sales, so on and so forth. After Thanksgiving, credit cards have a tendency to jump every year, and this has always been the case. Always been the case during the holidays. So this is just the credit. Now, you look on the left side of the axis here. It is true that on a gross figure, it is higher than it was pre-financial crisis, but just barely. Now, we know there's been a lot of money printing both on the central bank side and now on the bank side, direct with Treasury stimulus checks because of COVID. But, even during the thick of the COVID crisis, people weren't spending online. They were saving. They're continuing to save. Yes, now it is higher in gross nominal terms than it was in pre-financial crisis. We were right about $1 trillion here, December 2007. Now we're at $1.2 trillion. So we are higher by 20%. But, that was 15 years ago. The dollar is very different at the time. I'm not saying it's a good thing. I'm not saying it's great to carry a credit card balance. Pay off your credit cards if you can. Don't pay that interest to the credit card company. Use all the miles, use all the points and everything. But if you look at this as a percentage now of checking accounts, you can see that there's much more cash in the bank than there is credit card debt to be paid. So that's the interesting thing here about credit cards. They are just one form of liability that you and I have to pay every month. We can go throughout the economy, facilitate the intermediation of buying and selling without even affecting the money supply. Credit cards do not affect the money supply. They're not a part of it. The only time that a credit card balance will hit the money supply is when people pay it off at the end of the month. So remember, there's $10 trillion worth of payments that have been made in the United States in 2022, $9.6 trillion worth. Credit card debt is, a little over 10% of that, $1.2 trillion. So most people pay off their credit cards every month, as they should, and certainly much more than we're doing it on the eve of the global financial crisis. There are negatives to credit cards. There are privacy issues. I'm aware of that. You should be aware of that. This is a challenge that my buddy Alec from Halo Privacy can help you with, and many people are trying to manage these days as everything is being recorded, tracked from your phone to your computer to your car to cameras outside of your car. There are many, many things that are being tracked these days. It's difficult if you want to truly maintain privacy. I don't think credit card companies are helping there at all. But as far as the genesis of credit cards, facilitating payments throughout a nation's economy and throughout the world, credit cards are a big boon. They're a big boon to the economy. And I'm pretty sure that credit card debt is not as nearly as big as you thought it was. Always remember, When you swipe that credit card, you are actually not affecting the money supply at all. The money supply doesn't see what you did at all. The only point where your transaction hits the money supply is when you pay back the credit card company at the end of the month. Thanks a lot for watching. Take care.